Welcome to our November Investment Committee Outlook. As we head into the final weeks of 2025, markets continue to evolve against the backdrop of shifting economic conditions, policy changes, and strong but uneven corporate performance. Today, we'll talk you through the key developments shaping the current investment landscape and how we're positioning portfolios as we approach the new year. Volatility has picked up in the U.S. stock market recently, but the underlying fundamentals remain constructive for long-term investors. Lower interest rates are playing an important role as the Federal Reserve has been cutting interest rates since late 2024 in response to a softening labor market and inflation that remains somewhat elevated. The recent government shutdown temporarily disrupted economic data, making it harder for policymakers to interpret the full picture, but another rate cut is still expected either late this year or early next. Corporate earnings continue to be of notable strength, with S&P 500 earnings growth roughly 13% year over year in the third quarter and outpacing expectations. Technology remains the primary earnings driver, with projected earnings growth above 20% over the next 12 months. At the same time, risks remain present. Some large tech firms may be overspending on AI-related data center expansion, and the S&P 500 remains heavily concentrated in technology, now accounting for more than 1/3 of the index. U.S. stock valuations remain elevated, with the market trading above 22 times forward earnings. In contrast, international markets offer more attractive valuations and have delivered strong performance this year in regions such as China, emerging markets, the EU, and Japan. With the government reopened, investors are beginning to shift focus towards potential economic support from new tax measures and increased fiscal spending that could boost activity into 2026. As we enter the final stretch of the year, we are maintaining our disciplined, long-term approach, and no major allocation changes are planned at this time. We are making one target adjustment, with small and mid-cap equity exposure replacing a long-held fund in this category with a Fidelity alternative that offers stronger performance and lower expenses. We also recommend rebalancing portfolios in the near term to ensure allocations remain aligned with each client's long-term goals and risk expectations. Managing concentration risk remains central to our strategy, and we continue to favor diversified portfolios and actively manage high-quality funds to help balance the heavy weighting of large technology companies in today's markets. In addition, we modestly increased our international equity allocation earlier this year to take advantage of more favorable valuations and stronger relative performance abroad. Despite recent volatility, our long-term outlook remains constructive. Earnings growth, improving interest rate conditions, and broader global opportunities continue to support disciplined, balanced investing. Our investment committee will continue monitoring economic trends, inflation dynamics, labor market conditions, and sector concentration risk as we navigate the months ahead. If you have any questions about your portfolio or would like to discuss our market outlook in more detail, please don't hesitate to reach out to your WHC advisor. As we approach the holiday season and prepare for the start of the new year, we want to wish you and your loved ones a joyful, healthy, and peaceful celebration. We look forward to partnering with you in 2026, providing absolute confidence and unwavering partnership for life.